Well, good afternoon, everybody. We've got a good audience here today for a topic that I don't think ever gets old, and that is Social Security and retirement planning. Welcome to the ongoing Corpco Retirement Group Lunch and Learn series. Today, I'm pleased to introduce a real expert in the area of Social Security, Kurt Sarnowski. I've known Kurt at least 10 years, but his background is very appropriate. He was 34 plus years at the Social Security system for our government. He was involved in education and training and managing director there. And he has his own consulting group. So today we're just going to start out with some basics and leave plenty of time for Q&A. If people want to type in a question, please do. If you're listening in on behalf of clients or family members, feel free to fire away the questions. So today we'll cover just at a higher level, Social Security and, maybe at the right time to take it, what age, how does spousal benefits work? If you want to keep working, while you're collecting, how does all that enter into the equation? So with that, and it is being recorded, so I will push out a recording once it gets edited to all the clients. So with that, I'll hand it over to Kurt.
Hey, thanks, Dave. Good afternoon, everyone. Yeah, great to be here. Kurt Sarnowski. As Dave said, I worked for the Social Security Administration for 34 years, was able to retire at the end of 2010, and I'm now in the 11th year in my retirement. But when I was with Social Security, I was the communications director in New England, which meant I spent my time talking to people about the program. I've been lucky enough to continue to do that work, largely because I enjoy it, but also because I think there's a real need for the information. Believe it or not, the Social Security program, now more than 86 years old. Each and every month, Social Security pays over $92 billion in benefits to just about 65 million people. And on top of that, there's another 176 million folks who are now out there working and paying into the program. And what I saw during my time with the agency, despite the age of the program, despite the size of the program, and despite the economic impact that Social Security has in this country today, unfortunately, there's still lots of myths and misunderstandings about how the program operates, about what it is as well as what it isn't. So happy to spend some time with you this afternoon, looking to help you better understand what the Social Security program is, realize what it isn't, dispel some of those myths and misunderstandings, and set you down the road to the comfortable retirement we all hope to enjoy. Most important slide of the presentation is going to be this one. You'll hear me reference it over and over again. As I talk to folks, people need to understand that when Social Security was created back in 1935, the program was put in place simply to provide you with a base or a foundation, if you will, of income that you can count on being there for you, but it was a base or a foundation of income that you must take steps to supplement, because Social Security was never intended to be anyone's sole source of income in retirement. But unfortunately, these days, are about 25% retiree couple households, the Social Security money they get each month is virtually the only income they have. It's a terrible situation. So how do you and your clients avoid that happening to them? Well, simple, by planning for retirement. And to be commended, taking time out of your busy schedule, spending a little time with us this afternoon, learning about the Social Security program, planning for this aspect of your retirement. Now, for the longest time, the Social Security Administration tried to play a more proactive role in helping you plan for retirement, because back in the day, they used to mail you on an annual basis a paper document, Social Security statements. Those statements, the original distribution plan, had them going out, showing up in your mailbox about 3 months before your birthday, if you're 25 years of age or older, had ever paid into the program. And that statement, hopefully, as you recall, had important retirement planning information in it, benefit estimates at 3 different ages. And the other thing the statement did that was so important, it provided you a nice year-by-year breakout of what Social Security had recorded as your work and earnings under the program. We'll see in a little bit what you collect each month is related to what your work and earnings have been. So it was important when you get that statement to review the earnings history, and if a mistake had occurred, catch it and correct it, because if you didn't, have a direct impact on what you eventually received. But you may have noticed, hey, I haven't got one of those every year lately. What's the deal? Well, Social Security has significantly altered distribution plans for the statement, And the big news is they no longer mail paper documents to anyone and everyone 25 years of age or older. Instead, what they've done first and foremost is set up a system whereby if you go to www.socialsecurity.gov/myaccount and take about 10 or 15 minutes or so to set up an individual My Social Security account for yourself, an important byproduct of having that account in place is you'll be able to download through a secure website a Social Security statement for yourself whenever you need one or want one. And so, homework assignment for me, if you or your clients have not yet set up individual My Social Security accounts, you really should do that. Once you start to collect Social Security benefits, a whole bunch of advantages come from having that account in place. But prior to retirement, the big one is you're able to download a Social Security statement whenever you need one or want one. You're going to do some retirement planning. Being able to bring a current Social Security statement to that meeting, going to make it a more worthwhile exercise. So take advantage of that planning tool designed to help you recognize programs intended to provide you a base or a foundation of income, but it was never intended to be your only source of income in retirement. And the sooner you recognize that, move from what Social Security provides to where you need and want to be for retirement, the more likely you are to achieve that goal. So plan for retirement and use that Social Security statement. Now, when I talk to folks about retirement planning, I think the most frequently asked question has to be, well, when should I take my money? Most people are always interested in. So understand this. Under the rules, you've got choices and you've got options. What I'm trying to do this afternoon is make sure you fully understand what those choices and options are. In other words, I want to make sure you fully understand what you can do under the program. But ultimately deciding what you should do, that's your choice, your decision. After all, you're the ones who worked and paid into the program. I can tell you what you should do. But my view is, unless and until, though, you fully understand what you can do, you're in no position to decide what you should do. So let's make sure you understand the choices and options that are out there. So in the end, you're making an informed decision. And the place to start is by making sure you know what Social Security calls your full retirement age. Key concept under the program. When Social Security started back in 1935, Congress set full retirement age as the month you turned age 65. It was age 65 for everyone without exception, and continued that way for quite a while until 1983, when Congress changed the law, increased Social Security full retirement age when anyone born 1938 or later. The increase gradually been phased in over time. For a big chunk of us baby boomers, any of us who happen to be born between 43 and 54, it was the month we turned 66. But it continues to increase. And on current law, anyone born 1960 or later has a Social Security full retirement age as the month he or she turns age 67. Now understand this, collecting at full retirement age isn't someone's only choice or option, but make sure you or your clients or the folks you're helping fully understand what his or her full retirement age month is based on year of birth, because you'll see a lot of features of the program do flow from at least having reached full retirement age. But in terms of collecting benefits, you have to start the month you hit full retirement age. That means one thing and one thing only. It means you'll receive 100% of the amount your work and earnings entitled you to collect. That's what full retirement age month is, 100% of your benefit. And as I said, we'll talk in a second how that all gets calculated. But among the options you have are to start prior to full retirement age, if that makes sense. And under the rules these days, you can start to collect Social Security retirement payments as early as the month you turn age 62, or at any point in between, by the way. But here's the thing. Social Security, as the name implies, is a social insurance program. And Congress has built certain social goals into it. And one is a hope that at the end of the day, based on average life expectancy, you end up with roughly the same amount of total lifetime payments, regardless of when you start to collect. And so you have to start prior to hitting your full retirement age. Well, because now then, by starting sooner, in theory anyway, you'll be collecting for a longer period of time, you find your payment amount gets reduced. How much of a reduction? Well, it's roughly 0.5% per month for each month prior to your full retirement age you opt to collect. 0.5% per month, roughly a 6% per year reduction. By starting early, but you don't have to start on your birthday. You don't have to start the first of the calendar year. But if you opt to start prior to hitting your full retirement age month, you'll find your benefit now reduced by roughly 0.5% for each month you're going to collect. And oh yeah, it's a permanent reduction. Another one of the myths that are out there, too many folks mistakenly think, yeah, I know I'll start early, I'll get less, but as soon as I hit my full retirement age, my payment will zoom back up. Permanent reduction. Again, the idea being you're starting sooner. So in theory, anyway, based on average life expectancy, you'll be collecting for a longer period of time. So you're given less on an individual monthly basis. Excuse me. As I mentioned, you start full retirement age month, you get 100% of your payment. But among the options you have are to wait past full retirement age, if that makes sense for you. And with that social insurance idea in place, if you've opted to delay, well, then by starting later, in theory anyway, you'll now be collecting for a shorter period of time based on average life expectancy. So by all rights, your payment ought to be increased if you wait. And it is, referred to as delayed retirement credits. And for each month past your full retirement age you defer, you'll see your benefit now increase by 0.2%. 0.2% per month, that translates into an 8% per year increase by waiting. But again, you don't have to not collect for a full year. For each month past your full retirement age you defer, benefit permanently increased by that 0.2%. But here's the key thing. Delayed retirement credits only accrue from full retirement age until the month you turn age 70. Now understand this, under the rules of the program, you never have to take your Social Security payments. Not like there's a required minimum distribution or anything like that. But if you opt to defer from full retirement age until the month you turn age 70, you'll see your payment permanently increase by that 0.2% for each month you haven't collected. You opt to wait past that point before starting, and it's your right to do so. You'll see no additional increase in your payment because you waited. Let me give you a quick example. There's somebody with a full retirement age of 67. And let's say at her full retirement age of 67, she'd get $1,000 a month. What are the options that are out there? Well, she wants to start the earliest point right at age 62. The way the reduction factor works out, she gets 70% of that full retirement age amount. In other words, she doesn't get $1,000 a month, she gets $700 per month and continuing. Well, yeah, she's getting $300 less each month than she'd receive if she waited, but the trade-off obviously receives that lower amount sooner, and in theory then collects it for a longer period of time. At age 64, she'd get more, $800 a month and continuing. At her full retirement age of 67, that's when she gets the $1,000 that a work and earnings entitled her to collect. Let's say she wants to wait all the way until age 70 before starting to collect. Well, she'll see her payment now increase by 8% for each one of the 3 years that she's deferred, 8% per year. And it's simple interest, not compounded, but it means her payment at age 70 is 24% higher than her full retirement age amount. In other words, she doesn't get $1,000 a month. No, she gets $1,240 per month and continuing. Well, let's say she wants to wait and start at age 72. Still gonna be that same $1,240, right? No additional delayed retirement credit increases past age 70. Bottom line, your choice or your client's choice. What are the things they ought to be thinking about? Well, you know them as well as I do. Someone's health, longevity, then they need the money, going to keep working. All those factors have been in play, but the whole idea always used to be based on average life expectancy. It really wasn't supposed to matter. It's supposed to end up with about the same total amount of lifetime payments, regardless of when you started. But you know what? Life expectancy is increasing. Social Security number saved today is 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 to age 95. And for most boomers and those who come after us heading into retirement, if you have any type of pension at all, it's far more likely to be that defined contribution type, right? 401k, 403b, 457, where people are walking out the door at retirement, not with that traditional defined benefit pension and the guaranteed stream of lifetime income that comes with it. No, they're walking out the door with a pile of money. So it seems likely to me that later in retirement, that pile of money will have diminished. Healthcare costs may be higher. So people may have a greater need for a higher monthly income later in retirement than would make that initial transition. And one way they can help meet that need is by delaying the start of Social Security payments. But again, for me, not for me to say. Their choice, their decision. But I want people to be making an informed decision. And in its simplest, you start sooner, you get a lower amount for the rest of your life. You wait longer before you start, you get a higher amount for the rest of your life. But to me anyway, when Congress set that reduction rate and increase rate so many, many years ago, based on average life expectancy at the time, it was all supposed to come out about even. But these days, because life expectancy is increasing, I tend to think that perhaps good things come to those who wait. But it's not for me to say. The individual's choice, individual's decision. Second area I always got questions about was, well, how do they figure out how much I'm getting anyway? So as I mentioned before, there is a relationship between your work and your earnings and what you eventually collect, but we'll see in a second, it's not a perfect correlation. But in calculating payments, Social Security uses a formula Congress has written right into the law. Formula has a number of different steps. First step, Social Security will go back and adjust someone's prior year earnings for inflation, bring them all up to what they are in today's dollars. But then once they've done that, they calculate somebody's benefit by plucking out and averaging his or her, wait for it, highest 35 years of work under the system. None of the most prevalent myths. Too many folks mistakenly think it's my high 3, right? Or my last 5. Social Security benefits are based on an average of a lifetime of earnings, which these days defined as someone's highest 35 years of inflation-adjusted work under the system. So what happens if somebody doesn't happen to have 35 years where they've actually paid into the program, taking time out of the workforce to raise kids, care for aging parents, perhaps work for a while in a job where they weren't paying into Social Security? Unfortunately, no provision for that. Still going to be an average of your highest 35 years of work under the system. And if you don't happen to have 35 years of something, zeros get added in for those additional years, lowers the average monthly wage and lowers the person's benefit. Here's another takeaway for this afternoon, another reminder about Social Security being that social insurance program. And in putting the formula in place, Congress has recognized that people in lower paying jobs, less likely to have a pension, less likely to be able to save for retirement during their working years. So the system does try and help people in lower paying jobs by providing a monthly benefit, which is intended to replace a higher percentage of that person's pre-retirement income, somewhere in the neighborhood of 55%. For a higher earner, by all means, he or she receives more in absolute terms each month than the low earner does. But if you look what that payment represents, it's actually designed to replace a smaller percentage of that person's pre-retirement income, somewhere in the neighborhood of 34%. And for the average worker these days, the Social Security payment only intended to replace around 41% of what he's making. In no case, high earner, low earner, or average earner is the payment intended to replace 100% of what somebody's making, which leads us back to that first slide I showed you. People need to understand it's intended to be a base or a foundation of income, but you got to find ways to supplement it because it was never intended to be anyone's sole source of income in retirement. Two numbers to think about this afternoon. In the year 2021, the average Social Security retirement benefit being paid is $1,543 per month. $1,543 average comes out to a little over $18,500 per year. Then I often get the question, well, is there a maximum payment that Social Security makes? Well, in the year 2021, for someone who this year is at his or her full retirement age, which is 66 years and 2 months, and who for each of the past 35 years has had earnings at or above whatever the Social Security taxable maximum has been for each of those years, that's an important point. Each year, there's a maximum level of earnings upon which you pay Social Security tax. This year, you could make $500,000, but you only pay Social Security tax this year in the first $142,800 that you make. So when it comes time to average someone's earnings to calculate his or her benefit, Social Security only averages in the earnings that had been subject to Social Security tax. So again, to recap, in 2021, someone at his or her full retirement age of 66 years and 2 months, who for each of the past 35 years has had earnings at or above the taxable maximum, this year he or she receives $3,148 per month, or $37,776 per year. Nothing to sneeze at, but again, a base, a foundation. People must take steps to supplement it because it was never intended to be anyone's sole source of income in retirement. Third area I often get questions about is, well, what about working in retirement? How does that all come together? Well, this is another area what's vitally important to know what your Social Security full retirement age month is. Because under the rules of the program, if you are under your full retirement age, looking to collect Social Security payments, but intending to work at the same time, you need to understand that you're limited in how much you can earn before it begins to impact your ability to collect. And in 2021, if you are under your full retirement age, you're allowed this year to make up to $18,960 without any loss of benefits whatsoever. $18,960 or less, yeah, you'll collect full Social Security payments every month of the year. Now you make above that doesn't mean you can't necessarily collect at all, but Social Security is required to hold back $1 in benefits for every $2 that you're over the threshold. So depending on how much you're making while working, you may not be able to collect even if you choose to, because if you're under your full retirement age, you're subject to this earnings limitation. What counts towards that $18,960? Wages and or net income from self-employment only. In other words, earned income. Unearned income like a VA benefit, 401k distributions, bank interest, none of that counts. Earned income only. The great news is, from the month you reach your full retirement age on, there's no longer any earnings limitation whatsoever. And from your full retirement age month on, you can work and earn as much as you like and collect full Social Security benefit payments at the same time. Often get asked, hey, I'm retired, but I'm thinking about going back to work. I don't have to pay Social Security tax on my earnings, do I? Well, yes, you do. If you're in a job covered by Social Security, you will pay Social Security tax on those earnings. Good news for the folks at Social Security because they can use the money, but there's potentially good news for you. As I mentioned, your benefits calculated by averaging your 35 highest years of inflation-adjusted work under the system. And it's your high 35, regardless of when they occurred. It isn't necessarily your first 35. It isn't necessarily your last 35. It isn't even necessarily 35 consecutive years. So even if you're retired, you go back to work, pay into the Social Security program. At the end of the year, you file your tax return. Well, the good news is Social Security will automatically do a match. They'll compare that new year of earnings with the lowest of the 35 years they had been using to calculate your payment. And if the new year of earnings is higher than the lowest of the 35 years, they drop out the low year, plug in the new year, result in a benefit increase for you going forward. And this ability to increase your payment for additional work continues forever. Was delayed retirement credits? Yeah, they stop at age 70. No additional bump past age 70 for not collecting. But no matter how old you are, if you're working, paying into the program, and your earnings are higher than the lowest of your 35 years, you're going to see your payment increase as a result of those additional earnings, no matter how old you are. And frankly, the other bit of good news is work really never hurts. You've been a high-priced executive, but in retirement, take part-time job at the local golf course, driving the beer cart around, make a couple $1,000. Well, at the end of the year, that couple $1,000 is probably going to be lower than the lowest of your 35 years of work. So what happens to your payment amount going forward? Nothing. Stays the same. It's always based on your high 35, regardless of when they occur. So a little while ago, I said, I thought good things come to those who wait. Good things can come to those who work as well. Because as long as you're working, paying into the program, there's always the possibility you'll see your monthly benefit increase. It's never going to drop if you have a lower year of earnings. So quick reminder about spousal benefits under the Social Security program. Now, for years, you may have heard about those esoteric Social Security claiming strategies that were all the rage in a way that Social Security couples could optimize or maximize their lifetime Social Security benefits by coordinating the collection of benefits and utilizing some of these claiming strategies. You may have heard of the term file and suspend, or claim some now, claim more later, or filing a restricted application. Well, they were wonderful ways that couples could indeed optimize their benefits, but they were such a good deal that Congress decided to eliminate them with passage of something called the Bipartisan Budget Bill of 2015. And all of those claiming strategies have largely been eliminated. So in terms of Social Security spousal benefits, we're back to the basics, blocking and tackling in football parlance. And here's how the Social Security spousal benefit program works. You're looking to collect benefits based on the work and earnings of your spouse. Social Security says, well, at whatever age you're at, you have to take your own retirement benefit first. And at that point, Social Security will compare your own retirement benefit with 50% of your spouse's full retirement age amount. And if your own benefit exceeds 50% of your spouse's full retirement age amount, well, you collect solely based on your own work record. But if your own full retirement age amount is less than 50% of your spouse's, well, you always get your own and then some additional money on top of that, up to that 50%. But it's always one or the other, whichever one is higher, but you don't get both at once. Now, for you to collect the spousal payment, your spouse has to be collecting his or her own retirement benefit first. And the earliest age you can collect spousal benefits is age 62. If you're under full retirement age, sure, you'd suffer a reduction just as in your own retirement benefit. But it's 50% comparison between your own full retirement age amount and 50% of your spouse's. And if your own exceeds 50% of your spouse's, no two ways around it, you collect your own. And since it's higher than 50%, that's all you collect. If it's less, you get your own plus some additional money. Now, survivor benefits, well, it's a little more generous because the comparison is between your own and 100% of your now deceased spouse's benefit. But again, you collect one or the other, whichever one is higher, you don't get both at once. So spousal benefits, survivor benefits, incidentally, with divorced spousal benefits, with spousal benefits, you simply need to have been married for 1 year duration of marriage requirement. But for you to collect benefits as a divorced spouse, the marriage must have lasted at least 10 years. Second, you cannot be married. To collect on your ex, you cannot be married. Your ex can have remarried without impacting your ability to collect, but you cannot be married. And thirdly, you have to be at least age 62. That's the earliest age you can collect. Now, with divorced spousal benefits, the law says, unlike with regular spousal benefits, when your spouse actually has to be collecting, you can draw benefits as a divorced spouse as long as you're both over the age of 62. Divorce was finalized at least 2 years ago. Then you can collect even if your ex has not yet started to collect. With all those conditions being met, what are you entitled to receive? Well, simple, as if the marriage were intact. You collect your own retirement benefit first, and if it's less than 50% of the full retirement age of your ex-spouse, well, sure, you get some additional money. But if your own exceeds 50% of your ex's, that's all you get. Spousal, divorce spousal, and survivor benefits. Quick reminder about taxation of benefits. Taxation of benefits came into being in 1983. Congress set thresholds saying that higher income Social Security beneficiaries were required to pay federal income tax on a portion of their benefit payments. Back in 83, they set the threshold as $25,000 for a single tax filer, $32,000 for a couple, and it's all sources of income, earned and unearned. If you had income below those thresholds, sure, no portion of your benefits would be subject to federal income tax. But they've never indexed those thresholds, and these days, depending on how much you have an income above those thresholds, you could find yourself having to pay federal income tax on up to 85% of the payments you had received in the prior year. 15% always federal tax-free, but up to 85% treated as ordinary income, taxed at whatever marginal tax rate you're at. These days, about half. People collecting Social Security do find themselves paying federal income tax on a portion of their benefit payments at the end of the year. Social Security will send out a 1099 form, and people use that in filing their tax return. Question comes up, does Social Security automatically withhold a portion of my payments every month, send to the IRS like they do for my salary? The answer is no, they don't do it automatically. But if you'd like to have it done at your request, Social Security will withhold a portion of your benefit payment, send it off the IRS in advance, and perhaps avoid the need for filing quarterly estimates. But federal taxation of benefits, something people need to plan for. And again, this is federal taxation rules apply across the country. In terms of state taxation of benefits, well, the vast majority of states, 37 out of the 50 states, do not tax Social Security benefits at the state level, including here in the Commonwealth of Massachusetts. But that leaves 13 states around the country that do tax Social Security benefits at the state level. Here in New England, the states of Rhode Island, Connecticut, and Vermont do impose state income tax on a portion of somebody's Social Security benefits. So for you or folks you're advising, depending upon where they end up in retirement, just need to check with the state taxing authority, as they may find themselves having to pay federal state income tax on the portion of the payments they had received in the prior year. All right, so you've got a client who has reached the end of his or her rope, intends to retire at the end of December. I've had enough. Want to start collecting Social Security effective with the month of January of 2022. How do they go about doing that? Well, Social Security can accept an application for benefits a maximum of 3 months in advance of the month the person wants to start to collect. So your client looking to collect effective with the month of January, they can apply right now and ask to have their payments begin effective with January. How do you do that? Well, the simplest, easiest, most convenient way is to use Social Security's online retirement application, accessible at socialsecurity.gov. Takes someone 15 or 20 minutes from the comfort and convenience of their own home. Now, it is important to note that to utilize the online retirement application, somebody does need to have set up a My Social Security account for themselves in advance. So another reason why you or your clients should do that right now. But if someone is not comfortable applying online, well, you can call Social Security's 800 number and make an appointment for what is called a teleclaim, not altogether different from telemedicine appointment. And they'll call you at the appointed hour, complete the application with you over the telephone. Now, at some point, post-COVID, local offices will reopen to the public and people will be able to make an appointment for an in-person interview at a local office. But right now, local office is still closed to the public. So anyone interested in dealing with someone from Social Security, getting help, does need to make that telephone claim appointment. Just a reminder though, Social Security benefits go out 1 month in arrears. So your client looking to collect effective January of 2022, he or she is going to see that first payment in the month of February. The January payment sent out in February, February payment sent out in March, yada, yada, yada. The other thing for people to understand too is that since 1997, Social Security benefit payments are staggered through the course of the month based on somebody's date of birth. Prior to 97, everybody got paid on the third day of the month, but Social Security recognized with the impending retirement wave of the baby boomers, they needed to do something to help spread out the impact on the banking community. So these days, if you or your client has a birth date between the 1st and the 10th of the month in which you're born, you will always see your Social Security payment direct deposited into your bank account on the 2nd Wednesday of the month, regardless of the date. Someone's birth date falls between the 11th and the 20th. They're always having their payment direct deposited on the 3rd Wednesday of the month. And birth date falls between the 21st and the end of the month in which they're born. Payment direct deposited on the 4th Wednesday of the month. So you've got a client retiring December 31st, date of birth is the 25th of the month in which they were born. They just need to recognize they're not going to see their first Social Security payment until the 4th Wednesday of February. They just need to plan for that because, as the great philosopher Belichick says, it is what it is. All right, open it up to questions, but I'd like to close where I started. That important reminder for you or folks you're helping, just remember Social Security, tremendously important program, but designed simply to provide a base or an income, base of income, foundation of income. People need to find ways to supplement it. And the sooner they take those steps, the more likely are to have that comfortable retirement. So Dave, turn it back to you. See if we have questions from folks who are out there.
We had a couple questions come in. I'll just take the first one, which is a common one about people receiving other pension benefits. You know, if someone receives a private, you know, if they were lucky to receive a private defined benefit pension, or maybe a union pension, or maybe they had a railroad pension. You know, the question is common, you know, does that offset any of my Social Security?
Great question, comes up all the time. And in answering that, it's important to distinguish between a private pension and a public pension, and a public pension, which is based on work not covered under the Social Security program. So if somebody's lucky enough to get a General Electric pension, defined benefit pension, the receipt of that pension has no impact whatsoever on that person's Social Security benefits. If someone is lucky enough to receive a public pension, which is based on work, though, that was covered under Social Security, For example, teachers in New York State pay into Social Security at the same time they're paying in the state teachers' retirement system. Well, that type of public pension also has no impact at all on somebody's Social Security benefit. The type of pension that does have an impact is that public pension based on work not covered under Social Security, such as teachers' pension here in the Commonwealth of Massachusetts, state and local employees in the Commonwealth of Massachusetts. They don't pay into the Social Security program. That public pension impacts people in one or perhaps two different ways. The first is if you get that public pension, but in addition to your time in public service, you have also worked and paid into the Social Security program, then you'll be subject to something called the Windfall Elimination Provision, abbreviated the WEP. Now, the great news is, as long as you've had at least 10 years of time under the Social Security program, you will always get something from Social Security each and every month, even if you receive that public pension based on work not covered under Social Security. That's the good news. The bad news is, with fewer than 30 years paying into the Social Security program at a substantial earnings level, the amount you get each month from Social Security won't be as high as it would have been if you didn't have that public pension, because the windfall provision requires Social Security to use a different and admittedly less generous formula to calculate the amount of your Social Security benefit. But you're always going to get something from Social Security, even with that public pension, as long as you've worked and paid into the system for at least 10 years. The other situation, though, it's how that pension impacts your ability to collect benefits as a spouse, divorced spouse, or widow or widower. And here, frankly, the news is not as good. This is called government pension offset. And before Social Security will pay you any additional money you might be entitled to collect based on your spouse's, ex-spouse's, or deceased spouse's work history, they're going to take a look at the amount of that public pension, figure out what 2/3 of that monthly pension is, and reduce any type of spousal, divorced spousal, or survivor benefit by that 2/3 of your pension. So if 2/3 of your pension is more than the additional money you could collect based on your spouse, ex-spouse, or deceased spouse's work record, you don't get anything more. You always get your own Social Security benefit, because again, you always have to collect your own first. But whether or not you could collect any additional money depends on the amount of your pension. And under the government pension offset rules, depending on the amount of your pension, you could have that additional money reduced to zero. But again, you'll always get whatever Social Security payment you're entitled to collect, and you'll always get your own full public pension. But it's more a question of whether you could collect anything based on your spouse, ex-spouse, or deceased spouse's work record. And why does government pension offset exist? Well, because, as I mentioned, under the program, you collect on one or the other. You don't get both at once. If your own benefit exceeds 50% of your spouse's, well, you only collect on your own. And government pension offset basically adopts that formula. If your own work activity, albeit in the public sector, has generated a benefit for you that exceeds what you could collect on your spouse, well, you don't get both, one or the other, whichever one is higher. So windfall and government pension offset. Key thing is they only come into play, though, if it's a public pension based on work not covered under the Social Security program.
So there's one just fundamental question came in about when do you recommend a person applying for Social Security? If they're gonna base it on their full retirement age and it's this month, I mean, should they do 3 months before? How does that all work?
Sure. So under the rules, you can't apply any earlier than 3 months in advance of the month you want to start to collect. Does that mean you have to apply 3 months in advance? No. You can apply, the month you want to start to collect. But generally, by applying 3 months in advance, you get everything straightened away, handle any bumps that may come up along the road so that you're going to get that first payment on a timely basis. So it can't be any more than 3 months, but it doesn't have to be 3 months in advance. But keep this in mind. It's another area where your full retirement age comes into play. Because if you're looking to collect Social Security benefits prior to reaching your full retirement age, you can't be paid anything any earlier than the month you actually apply. So you decide you want to start to collect this month, October of 2021, you're age 64 or something like that. In order for you to collect effective with this month, you need to have filed an application before the end of October. You don't do anything till November. Well, you can't be paid for October. You'll be paid effective November on. But you need to distinguish that with somebody who is at or over his or her full retirement age. Because if you're at or over your full retirement age, you do have the option of requesting a maximum of 6 months of retroactive payments based on your date of filing, but nothing any earlier than the month you hit your full retirement age. So you hit full retirement age, 66 years and 2 months. Well, you can theoretically apply as much as 66 years and 8 months and request retroactive payments back to your full retirement age of 66 and 2. So under full retirement age, no eligibility for benefits any earlier than the month you actually apply. That's why I always say file well in advance, have everything set up so that you're paid on a timely basis for that first month that you want to start to collect. But if you're over your full retirement age, you do have a little bit of wiggle room that you can request as much as 6 months of retroactive payments. Well, you don't have to, but it is an option that isn't available to people who are under full retirement age at application.
Well, very helpful. So I want to, be respectful of everyone's time here. We're running over a bit, but it's a great topic we can keep engaging on. So I will post Kurt's email. If anyone has a specific question, but email it to me and I can certainly get it off to Kurt. He's been really good about responding quickly. So the idea, again, we hope to build on this, another Social Security lunch and learn, probably first quarter 2022. And everything again is recorded. So we'll have this out to everybody, give me a week or two to get it edited. Anthony will help that process. So I wish you all a good day. And I have to say, go Red Sox. All right.
Go Red Sox.
Take care, guys.
Take care, everybody. Stay safe, stay healthy.